Hello, everyone. Happy Monday. Hope everyone is doing good. In this video, I'm going to be doing a financial vehicle breakdown. It's a great way for me to learn this better for myself and possibly teach something new. This is in no way, shape, or form financial or investment advice. This is for entertainment and educational purposes only. Great. So I'll go ahead and jump right into it. So what I kind of want to break down today is financial vehicle, right? In this case, this is a TransAmerica, a product called Financial Choice Index Universal Life. I'll go into what exactly this vehicle is. So it is a life insurance build for tax advantage, choice, and flexibility. Um, Basically, it's a product to protect against future higher tax rates and market volatility at the same time. Basically, these products and this product specifically guarantee a specific amount at worst case scenario rate of return on your principal. So this is a tax advantage vehicle here. So index universal life insurance is not a security, and index universal life policies are not an investment in the stock market or in financial market index. Index account interest is based in part on index performance. Past performance of index is not an indication of future index performance. So this is not a security. It is not a stock. It is not a investment, right? This is a life insurance product. That is why it comes with the tax advantage benefits that majority of other similar products do not. So it has flexible contributions. Two major financial risks in the market are typically taxes and market volatility. As we're seeing in the stock market, it's going up and down, and down quite a bit from 2021. So that is market volatility, right? The fluctuation in prices in the market, and then taxes. I mean, we're seeing what's going on with the banks and all that. So potentially, it seems like they're getting bailed out. So whose taxes are going to go up? Ours, most likely, it seems like at the very moment. So this specific vehicle has they call flexible premiums, which is basically the contribution you put into one of these products per month, right? Contributions are very flexible. It's similar to like a traditional retirement account like 401k and so forth, and all these other four whatevers, because there's so many of them. So built-in cash value through index linked growth, so guaranteed downside protection of 0.25%. So regardless of what the market performance is you're guaranteed a 0.25% return. Tax-free supplemental income opportunity, tax-free loans and withdrawals, tax-free transfers. It's life insurance, so it comes with life insurance protection as well. Federal income tax-free death benefit, and option living benefit riders for qualifying critical, chronic, and or terminal illness, flexible or additional coverage options for you and other family members on the policy. Creating a personal plan using cash value life insurance can give you and your family tax-free access to the cash value of your policy at any time for any use. So any withdrawals and loans you take from the cash value bucket of the policy is tax-free. You don't pay taxes on that, on the withdrawals, right? And you can use it for whatever you want. A cash value life insurance policy may help you create a flexible source of cash to self-fund large expenses. For example, again, what you can withdraw from these, you can use it for whatever you want. You want to start a business, you want when your children to go to college, or tax-free retirement, right? You want to start withdrawing tax-free income as when you retire, and then utilize it to basically fund your retirement. Build a diversified and tax efficient retirement distribution plan, fund your new business, or grow your expanding one, like I was saying a second ago. Consideration is, so these are the considerations. If this is not something that aligns with you, this definitely doesn't make sense to you. If you do not keep paying the premium of the life insurance policy, you will lose substantial money in the early years. To be effective, a life insurance policy needs to be held in force until death. Tax-free distributions will reduce cash value and the face amounts of the policy. You may need to pay higher premiums in the later years to keep the policy from lapsing. You'll have to qualify medically and financially for life insurance, unlike the Roth IRA. Generally, there are many additional charges associated with life insurance policies, including but not limited to a monthly admin charge, index account monthly charge, cost of insurance charge, additional benefit rider cost, and surrender charges. So basically has a monthly admin cost, which is if I remember, about $10 per month. If you add additional riders to it, riders are basically additional add-ons to the contract that specifies certain benefits. You pay additional for those. Surrender charges are if you close the contract, you no longer want the life insurance policy, you get charged surrender charges. So those are some of the charges. So these are some of the considerations before even considering a product like this, right? So FCIUL, Financial Choice Index Universal Life, offers a diverse mix of index accounts that provide choices and control. Choose from domestic, global, and proprietary indexes that offer high or uncapped index account interest rates to help maximize policy value accumulation. It offers a 0.25% floor, meaning regardless whether the market crashes, your money grows at the worst case scenario, 0.25%. Opportunity to allocate cash among a variety of index options that focus on different market assets, geographies, and objectives. This is pretty cool. About this vehicle, 200% participation rate and no cap, and another one with the 14% cap. So the participation rate is pretty cool thing, because let's say, for example, the index you choose to allocate your funds within this product, the FCIUL, if let's say that index performs 6%, you have a 200% participation rate, so you get twice the returns. So instead of getting just a 6% return that the index performed throughout that year or throughout that period, you get double that. You get 12%. I think that is super cool. Cap rate strategy. If the index change is plus 18%. So if you have the 14% cap strategy, let's say, for example, next year, the index, hypothetically, S&P 500 does 18% return, you get 14% out of that 18% rate of return. The policy, insurance company, in this case, TransAmerica, gets the extra 4% out of the 18%. So it has various options. There is an uncapped option, which still has a floor which I think that's a pretty interesting thing, to say the least. And then this also has a basic interest account. So here it goes into some of the different indexes you can basically peg the policy to. And the new one is the Fidelity Small Mid Multi-Factor Index account, which is basically 70% US bonds, 30% mixture of small and mid cap stocks. Not overall like super risky like you would think when you think, oh, investing in small caps and mid cap stocks can be very, very risky. But considering the majority of the fund is US securities, it goes to be less risky with some potential of growth, because it does have small and mid cap stocks, which if chosen correctly can have great returns, right? But it is in that sense a little riskier. Fidelity Small Mid Multi-Factor Index account that provides exposure to small and mid cap securities, helps reduce volatility and deliver more consistent return. The reduced volatility part is the 70% approximately that's in US securities, bonds. And from my in my opinion, this index would probably perform the best in low interest rate environment. Why? Because bonds increase in value when interest rates drop. When interest rates rise, they decrease in value. Considering 70% of this fund's portfolio is in US bonds, in current environment, it probably would not perform that well, but it has other options, right? However, if you presume that, or you think that, oh, in the near term future, interest rates are going to drop dramatically, this fund will perform, in my opinion, very well. The other cool thing that comes with this specific index or strategy is that you can take up to a 5% index loan on it and get paid interest on that loan. I think that is pretty interesting, that you can take a loan against yourself, not pay any taxes on it, and then get potentially paid up to a 5% rate of return on that loan. So you're like your own bank, right? This is where people use the term infinite banking, where you basically finance your own loans and you get paid interest on your loan on top of that. That is pretty cool. The danger to the index loan is, though, if the index that that your policy is pegged to performs negatively, you take that loss. So in that case, you're paying if it does negative 5%, I believe, or for in this example, you pay that negative 5% in interest. So that's the danger of it as well. You can potentially earn 5% rate of return on your loan, or if the market is not doing well, you can potentially pay 5% on your loan. But it's an option, right? This is just one option of different loans you can take, from standard loan, which is a wash loan, you pay zero interest in. This is just one option of the loans that you can take on these policies. So it has many different options, right? And loans you can take, in many other things. So the different options for this, it has a basic interest account, which is a guaranteed rate of return that the insurance company basically offers this specific fund, where they can at any point change. It can fluctuate depending on what the insurance company wants to offer with this. Global index is the global economy, basically. S&P, Hang Seng, and the Euro stock. So it's Europe, China, and the US. S&P 500, everyone's familiar with S&P. It's for the top 500 large cap companies in the US. Global Plus Index account utilizes the same index as the Global Index account, but offers a higher cap and a potential to be credited with greater excess index interest in exchange for an index account monthly charge of 1% annually. So it has higher cap, meaning it could potentially perform better than the global index. However, you are charged a monthly index account charge of 1% approximately annually. And then the S&P 500 plus index account, the same as the S&P 500 index account, but offers a higher cap and potentially to be credited with greater excess index interest in exchange for an index account monthly charge of approximately annually 1%. So it has a higher cap, but in return for the higher cap, you pay a 1% annual fee. You can see the coloring here, and the darker it gets, the higher the risk. Which you would think this would be risky, right? Small and mid cap fund, but considering that majority of it is bonds, that's why it's on the more conservative side. So this is the uncapped one, the Fidelity Small Mid Multi-Factor Index account, which is right here, the one I kind of went into a little bit. That's has a 200 participation rate, meaning whatever that index gains, your returns are doubled because of the participation rate. It's uncapped. It has a floor of 0.25%, meaning you can't lose your money, and there are no index account charges on that. So you're not paying the fee that the other indexes are paying. So a surrender charge may result in cash surrender value of your policy becoming zero. So you have to be careful with canceling these policies, making sure that you have sufficient funds in the cash surrender account, because if someone were to want to cancel one of these policies, they will get hit with a cash surrender charge. So the purpose of this specific vehicle is cash accumulation, at the same time having protection on yourself, your family, and assets, and so forth, right? Because you created a estate through the life insurance portion of it. And at the same time, you're protecting yourself against potentially becoming disabled and having to utilize your money to pay for yourself as you recover or during that time, right? So this is more for someone that wants protection on their assets, on themselves, on their family, and at the same time wants to grow money. And so it's like two buckets: a bucket to grow money within, and then a bucket that from day one, depending on what makes sense to the person, right, they have an immediate estate that is will be there for use in certain situations, right? So can help you access cash value as tax-free income. So it's a way to protect yourself against future increases in taxes. Okay, so this goes into the loans that you can take on these policies. When your policy value is sufficient, you can utilize loans and withdrawals to use when and how you wish, such as supplemental retirement income, paying college costs, business planning, or to help pay off large expenses. As long as the loan does not exceed the amount of the premium paid, a life insurance policy loan isn't considered taxable income. If the policy lapse, is canceled, or expires because premiums are failed to be paid or is surrendered, the active loan plus interest is considered taxable income by the IRS at your ordinary income rate. So you do not want to allow this product to cancel on you or expire due to failure of making contributions, or you personally cancel it without considering the fact that you remove the vehicle that makes what's within it a tax advantage you remove the tax advantage benefit from the vehicle, right? These are the loans you can basically take against this policy. So no current charges with withdrawals. Two types of conventional loans are available. And these are conventional loans, standard loans available year 1 through 10 that earn 2% and are currently charged 2.75% and will not exceed 3%. Preferred loans available years 11 and up that earn 2% and are currently charged 2% and will not exceed 2.75%. Index loans available beginning of the 6th year of the policy. The value remains in the index account and earns the same interest rate as calculated for the unloaned value. The company reserves the right to discontinue the index loan at any time. That's the loan I was talking about a little while ago. So how does this instrument work? You pay the premium to your policy. Portion of your premium will go towards policy fees and a charge. So a portion of that premium goes towards your coverage, right? Your life insurance coverage, and whatever other fees that come along with the policy, such as the ones I described earlier. The remaining amount of the net premium can be allocated across a variety of indices, interest accounts. So whatever goes above the cost of insurance, whatever's left over from that, from the premium, goes towards whatever indices you decide and choose on to allocate your money or your contribution to grow in that bucket where the cash value grows. And then net premiums allocated to the indices accounts or basic interest account have the potential to build the policy's cash value in a tax deferred way. So what goes into the indices is basically what grows the cash account of this product. And then as for the coverage part of it, a portion of your death benefit may be paid to your beneficiary in as little as 72 hours. TransAmerica expedient claims can help funeral costs, other expenses to ease the burden on your loved ones. So that is what I was saying in terms of the coverage bucket, right? You have a cash value accumulation bucket and you have a coverage bucket where basically, God forbid something bad occurs, that can be used. So yeah, that's some of the stuff that I was find interesting in this policy here. So on comparisons to, for example, a Roth IRA to the FCIUL, Financial Choice Index Universal Life. So Roth IRAs, tax-free accumulations. Roth IRAs do have tax-free accumulations such as cash value life insurance in this case, because the FCIUL is a cash value life insurance type product. Tax-free distributions, Roth IRA does have, as well as this vehicle here, death benefit protection. Roth IRA does not have that. Cash value life insurance does. Required minimum distributions, the Roth IRA does not have that. Cash value life insurance doesn't as well. Contribution limits, Roth IRA has contribution limits. Cash value life insurance does not, to a certain extent, but typically is a lot. You have much more room in that in terms of contributions. Earnings limit to participation. Roth IRS does have that. Cash value life insurance does not. Tax penalty on early distributions. The Roth IRA does have that. If you're under 59 and a half, if you take certain withdrawals or early withdrawals, you can potentially get hit with a 10% penalty. And you do not have that problem with cash value life insurance. So cool. That's a little bit about this specific product here provided by TransAmerica. So this is a financial vehicle breakdown episode, basically. With that, I'll leave you guys with a quote. One lesson which monetary authorities seem to have to relearn every generation is that monetary policy works slowly but brutally. And we're seeing that right now with what's going on with the banks, and they're getting pretty hammered with their mortgage-backed security assets held for sale or held for investment, and their U.S. Related bond investments hold for sale or hold for investments. They're taking big losses on those assets there. And a little bit of history. In the summer of 1982, large American banks lost close to everything they had ever earned and more. That did occur in the early 1980s. Banks were making risky investments. And I believe it had part of it to do with investments going to Latin America, which it all just went to hell, and the banks lost everything they have ever earned and more in the early 1980s. So yeah, that's some cool stuff I want to share with you guys. Hopefully you learned something from that, and then that helps me learn it a little better myself. So thank you for watching. I hope I shared some valuable information with you today, and I'll see you on the next one.